the monetary sector. We started looking at the monetary sector. So we spent most of our time defining what money is. We looked at the functions of money and a bit of some history of money. So we gave the history of money and the payment systems, right? The evolution and the changes that have taken place. And this is the conversation that we had last time. But as for today, interestingly enough, we want to look at this other conversation. We basically continuation from where we ended last time. And we are starting from the functions of the central bank of the country. In our case, the Bank of Zambia. So what are some of the key functions of the central bank of the country, right? Then you need to look at that. Now, the functions of the central bank involve acting as the banker's bank. That is to say, the central bank controls all other banks. In other words, the central bank of the country is in charge of all other banks in the country. This is very important for you to understand as for now. Then the central bank is presented as the lender of last resort. Now, when we say the central bank is a lender of last resort, we simply mean when commercial banks are in need of money, they want to borrow money from somewhere. They try to ask from each other, right? When they find that there is no any other bank that is able to give them the money, then the last option, they go to the central bank when they, out of liquidity, they go and borrow. And the Bank of Zambia, in our case, or the central bank of any country, the Federal Reserve, in case of the US, gives or lends money. So that's what we mean by lender of last resort. It is the last option. The government is bank. You know, the government banks money, keeps money with the central bank. Generally, our national reserves, they are with the central bank of the, There is one key and important role that the central bank plays, and this one it is called controlling money supply. We have not put it here, but it's very important, and I think we have to add it. It controls to control money supply. Very important. Now, what do we mean by controlling money supply? As I indicated last time during the introduction, I made it clear to us that there is a group of economists or the school of thought in economics called monetary economics, producing the monetarists, right? Where we have these guys, or the economists that believe in money, in the supremacy of money. They say money can be used to adjust all other macroeconomic variables. And that's the message that they send. So they say you want to control exchange rates, you can use money. You want to control inflation, you can use money. You want to control unemployment, you can use money. You can literally use money to control the entire economy according to the monetarists. So now, the power to control the supply of this money, it is basically done by the central bank of the country. It should interest you to notice that the central bank of the country also issues notes and coins. You saw that probably last month, the central bank of our country issued the new notes. You now have 500 kwacha joint, 200 joint, there are those new notes and new coins. It is basically the bank comment much on other one, the money supply. The central bank is a policy, the government policy that is conducted by the central bank so as to influence money supply and the level of economic activities in the economy. It is called the monetary policy. Please, you have to get this one. The monetary policy, therefore, is a government policy conducted by the central bank of the country in order to influence money supply and the level of economic activity. By influencing money supply, we mean when the money is too much in supply, like you have too much money in supply, the central bank should adjust that supply of money, reduce the supply of money. Follow nicely. And again, the times when you have too little money, it means that in circulation you have too little money. The central bank of the country should increase the supply of money. So in short, it regulates. It has to be in charge, in control of how much money is actually in circulation. That's what we mean. Now, there are some key monetary policy tools that the central bank uses to control money supply, and these you should be able to give explanation on each of them. There are these three, key tools that the central bank uses when they are they are controlling money supply. When there's too much information, these tools. When there's too little tools to adjust the supply of money, that's the message being sent. The first one that I'm starting with is called the open market operations, OMO, right? OMO, open market operations. This one involves the buying, pay attention, it involves the buying and selling of what? Of government securities, government securities that involve the bonds and, treasury bills mainly. The treasury bills and the government bonds. So the buying and selling is what OMO is all about. Now, let me give a practical example on how it does work, the OMO. When you have too much money in supply, listen carefully, you have too much money in supply, all right? What does it mean? It's very incumbent to the government through the central bank to reduce the supply of money. How do they reduce the supply of money? Right? They want the money. They will sell. You're following, eh? When we want to reduce the money as a control of the measure, we sell the bonds and the T-bills. In other words, the government sells securities. When the government is selling securities, you know what happens? People will get their money, take their money to the government, right? People will take their money to the government to buy securities. And as that happens, then the money is reduced in circulation. I've not gotten this one. You have too much money in supply. Central bank realizes that, and they want to reduce the supply of money. So what do? They have to sell securities, the bonds to you. When they sell these bonds, you will use the money that you are keeping from circulation to buy these bonds. So you will remain holding bonds, which are basically the debt instruments. You will hold these bills and the bonds, and you will not hold money. So the central bank will get the money again In short, the money will go back to the central bank. That's one way of reducing money in circulation. You sell more bonds, right? A conversation about bonds, bonds in a nutshell, simply means you are lending money to the government, okay? The government wants money to run projects, all right? And so they engage the public. They say, all those that have money, please, you can lend us your money. We'll pay you back your money after this period of time with an interest, of course. I am trying to explain to you what treasury bills and government bonds are. So the government will borrow money through the central bank. And so the people who have money, they will lend their money to the government. And during the time when you are lending that money to the government, you will give your money and you remain without the money. You will just remain with an assurance that the government will pay you back. In the olden days, there used to be a certificate of deposit, the certificate that shows that you have lent money to the government. Nowadays, the system is electronic. If you check with the investors portal at the Bank of Zambia, it's electronic. Once you just invest, everything will be recorded online, electronically. So in short, we are saying the record will remain that you have lent money, you have given some money to your government, and then that government will pay you back that money, of course, with an interest. For the bonds, in a nutshell, the way how they work, usually they are long-term. That is to say, the minimum you can lend your money is 2 years for the bonds, okay? 2 years. You have the available tenors right now as I speak at the central bank of our country. We have 2 years bond, 3 years bond, 5 year, 7 year, 10 years, and 15 years. I'll go over that again. We have 2 years bond, 3 years, 5 years and 7 years bond, 10 years and 15 years bond. So in other words, you can lend your money to the central bank for that period of time, for that length. But what is interesting is the way how the government gives you the interest, right? Though this is not really the focus of this conversation. The government will give you the interest. Usually this time around, they give you every 6 months. If you buy a bond, maybe for example, for 10 years, it means in these 10 years, every 6 months, you're going to be getting some amount, all right? Some interest, you'll be getting some interest. Let's say, for example, listen, for example, for the purpose of argument, and I want you to get this. If you invested, for example, 100,000, and that 100,000 that you have invested, that you have used to buy bonds, you have lent to the government, and then the interest rate is 20%, just for an example. If the interest is 20%, what that means, the 20% of 100,000 is how much? It's 20,000, right? So yeah, it's 20,000. So it means every year you are making 20,000. You'll be making 20,000 on that bond. It's annually. Now, the central bank of our country, for example, the Bank of Zambia this time around, they do biannual system where they give you the interest twice, or the coupons, we call them the coupons, twice a year. So they will divide that 20,000 by 2, which gives you 10,000. So every 6 months, they'll be giving you 10,000 for 10 years. So every 6 months, you'll get a 10,000. Every 6 months, you'll get a 10,000. Every 6 months, you'll get a 10,000. That is what that means. If you invest 1 million, and the interest is, let's say, 20%, all right? Which means you make, that would be 200,000. Okay, that will be your interest every year, 200,000. Divide that by 2, which means 100. So every 6 months, you'll be receiving 100,000. Every 6 months, you're receiving 100,000. Every 6 months, 100,000. That is how the bonds work. We also have the treasury bills. The treasury bills themselves, they are quite shorter. They are short term. These, you have those for 3 months, There are 3 months. You have those for 6 months. You have those for 9 months. And for 1 year, maximum is 1 year. That is about the bonds, the treasury bills. So you are lending your money to the government for maybe 9 months. Then afterwards, the government will give you back your money with an interest. It doesn't really work like the bonds, like in between you're going to be receiving something. No, because the time is already short. The bonds are the ones that will give you some amounts every 6 months. Okay. Are you able to get me clear? I just wanted to share this knowledge a little bit. Maybe you can get some understanding. Are you able to hear me? Can you see the screen? Okay, that's fine. Anyway, back to the conversation. Let's get back to the conversation. So what the government would do, they will issue bonds. I wanted to talk about the bonds a bit so that you are not lost when I start saying bonds, the treasury bills, you understand how they work and what that means. So when the government sells these bonds, people who have money will buy these bonds. In short, they will lend money to the government. At that point, the focus of the central bank is to reduce the supply of money. That's what they do. At the same time, what if they want to increase the supply of money? That is if you have too little money in circulation, like, you have just too little and they want to increase the supply of money. Using open market operations, at that point now, instead of selling the bonds and the treasury bills, they'll buy. You get what I mean? Eh? They'll buy the government securities. And by government securities, I mean bonds and treasury bills. The government itself will buy. In short, they will start calling back those bonds and start buying them. They'll even buy corporate bonds. You get what I mean? So when they buy the bonds, they are using the money. So they are putting that money go into circulation. The money will go into circulation because the government will spend the money to buy those bonds, all right, from the public. Have you understood how the open market operations works and how we control money supply? The central bank, you're fine? Any question from anybody? Before I go to the other two, I'm just explaining these tools today. Monetary policy and the tools. Any question? But can you see the screen and can you hear me clear?
Yes, sir.
All right. Thank you so much for that. Now let's come to the second one, the reserve requirements. Reserve requirements. What about the reserve requirements? Now listen, if you do remember what I said last time, I made it clear to you that whenever you deposit, whatever amount that you deposit at the bank, all that money does not remain at the bank. No. The bank uses that money to make more money. If you go there, you deposit your money, you leave the money at the bank. Don't even think that your money is there. It's not there. And listen to the way how I'm using the word it is not there. That money has been sent in circulation to make more money. The banks give out loans, yeah? The commercial banks for that matter. They give out loans. I'm laying a background to the reserve requirement. I want you to pay attention. They give out loans to people so that they can make more money using people's money. Now, since the banks are profit-making organizations, it was observed, as you saw in the background that I gave you last time, that the banks have a tendency, they might have a tendency of giving all the money that people invest in and putting that money into circulation, give out loans, such that they remain with nothing at the bank. And when people go to withdraw, they have nothing to withdraw. Listen carefully. I am saying without regulation, if the banks go uncontrolled, all right, these banks go without control, they can end up just be giving out, they can end up up with just giving out all the money they have as loans and remain with nothing to meet the demands of those who are coming with withdraw. You get what I mean, eh? Now, in view of the same, the central bank, being in charge of all these other banks, steps in. You know what it says? It is sets what you call a reserve requirement ratio. A reserve requirement ratio. A reserve requirement ratio is basically a percentage from every deposit that should be kept at the central bank to meet the demands of those who are coming to withdraw. You have not gotten this one. As a way of controlling, the central bank comes in and says, no, these guys, if we leave them without controlling them, they'll end up, you know, they'll end up just making okay. So I was saying that the government or the central bank observed that these people will end up just be giving out the loans without even meeting the demands of those people who are withdrawing. So now the government is set to the minimum amount that you should keep at the bank to make sure that these people are coming to withdraw. That is the reason since 20% of every deposit out as loan, only 80% of every loan. What are we saying? First, requirement pressure is 20%. Out of 100, what? All right. Sorry, I've been logged out. So I was saying the 20 kwacha is what is going to be kept to meet, the demands of those who are coming to withdraw. Okay. Only 20 kwacha. The 80 kwacha will be given out as loans by that company or by that bank. All right. So now listen. Before I go any further on explaining on this one, I want you to understand it so that when I show you how it is used to control money supply, you understand. So the government through the central bank puts it and they say, guys, no matter what, if someone deposits this amount, 20% or maybe 10%, it varies. And when they usually put it. For the sake of demonstration, I can just say 20%. So if they say 20% of the money should be kept, if someone deposits 1 million, it means 200,000 should be kept at the bank to meet the demands of those who are withdrawing. And the 800,000 should be given out as loans by that bank. All right? Have you observed that sometimes when you go to the bank, there are limitations in terms of how much you can withdraw. You haven't noticed that you are limited. Even maybe the number of times you can withdraw, they'll say you meet the transaction limits. Do you know why they set all those limits? So that people cannot just be withdrawing anyhow. Because if they keep on withdrawing anyhow, we'll reach at a point whereby if people start withdrawing money and will not have enough cash to give them as to meet the withdrawals. Because the bank there where you left the money, that's that they gave out your money as loans. Okay, so they put all these limitations that you are limited. Even sometimes, you know how much you can get from ATM is even limited. If you are withdrawing some banks, they say if you are withdrawing any amount, maybe more than 10,000, you have to enter into the bank. Yeah. You are withdrawing 25,000, 50,000, you can't get via the ATM, go inside. So they are putting all these measures on, and if you're getting all that money, which means you can't go at 24 hours and withdraw the money. So they are putting all these limitations around. I'm not saying the limitations are bad. I'm just trying to explain to you how it works. So far up to here, have you understood how the reserve requirement works? Before I explain how it is used to control money supply. Do I have a question from anybody on how the reserve requirement is used? Can you hear me clearly then? Oh, anyone can just turn on their mic and shout they're able to hear us. Thank you. Okay, now that we know what a reserve requirement ratio means, this is how it is used to control money supply. Let's assume we have too much money in supply. Too much money in supply. What do we need to do as a central bank? We need to reduce the supply of money, right? So to reduce the supply of money, they have to increase the reserve requirement ratio. You get what I mean, eh? If you increase the reserve requirement ratio, it means that you increase how much should be kept at the bank without taking it into circulation. How much should be reserved by each commercial bank? If you increase how much they should keep, the increase in the reserve requirement ratio reduces the loanable amounts. You are reducing how much they can give out as loans. Get what I mean, eh? If you, for example, out of 100, you told them at first, you are telling them you can, out of 100,000, you can give 80,000 as loans and only keep 20% or 20,000. Now imagine you tell them that, no, the reserve requirement ratio is 40%, which means you have to keep 40,000 and only give 60,000. Have you seen how much that money reduces the loanable amounts? And once you reduce the loanable amounts, it means you're reducing money in circulation. Hope that is clear. To sum it up, there is an inverse relationship between money supply and the reserve requirement ratio. If it increases, the reserve requirement ratio increases, then the supply of money reduces, right? The supply of money does what? Does reduce. Any question? Someone has a question? Oh, there is no question. So basically that's that. Okay, what if now there is too little money in circulation? All right. We want to increase, isn't it? We want to increase the supply of money. What do? You reduce the reserve requirement ratio. Because when you reduce the reserve requirement ratio, what you're saying is that you're reducing how much the banks can keep to meet the deposit, the withdrawals. If you reduce how much they keep, it means you're increasing how much they give out as loans. That's how it works. So when you reduce the reserve requirement ratio, there'll be a lot of money that will be given out as loans. Yeah. And then you're increasing money in circulation. All right. Let me explain the last two that the central bank uses. It is called the discount rate. Now, what is a discount rate? Colleagues, a discount rate is basically the interest rate that a commercial bank pays when they borrow from the central bank. You never knew this. Let me repeat. You know, the commercial banks themselves do borrow from the central bank, all right? They borrow. Now, as they do borrow from the central bank, they don't just get that money for free. They have to pay back with an interest. The interest that the central bank charges the commercial banks for borrowing, it is called the discount rate. You have known the discount rate. Now that you know what a discount rate is, let me explain to you how it is used to control money supply. Let's start again. We have too much money in supply. When you have too much money in supply, what do you need to do? You need to reduce the supply of money, yeah? Now, in the quest to reduce the supply of money using the discount rate, how can it be done? You have to increase the discount rate. All right? If you increase the discount rate, you know what that does? You know what that does? If you increase the discount rate, you are making the borrowing cost to go up. In short, borrowing, of course, as far as the commercial banks are concerned, it becomes expensive to their part. So the banks will not borrow a lot of money from the central bank. If they don't borrow a lot of money, they'll have less money to give out as loans. Because you know the reason why they borrow? They're just borrowing that money to give you loans, those who want loans from the commercial banks, yeah? So they go to borrow from the central bank so that they can give you that money as loans. Now imagine the interest, the central bank increases the interest that they charge. Then those banks will opt to just reducing how much they borrow from the central bank. Others will not even borrow at all. That will reduce money in circulation. Therefore, when the central bank wants to reduce money supply, they increase the discount rate. There is an inverse relationship between money supply and the discount rate. All right. Let's have another scenario. Let's have now too little money in supply. Assuming we have too little money in supply, what do we have to do? We have to increase money supply at that point. That is our goal. How do you increase money supply? Reduce the discount rate. If you reduce the discount rate, that simply means that it is now cheaper for commercial banks to borrow from the central bank. And now that it is cheaper, more commercial banks will borrow more money from the central bank, and that money will be given out as loanable funds, and those loans will go into circulation and the money will go into circulation. So basically, this is how the central bank of the country controls money supply using these three tools. And for the purpose of an exam, you must be able to explain how these tools work one by one. All right. Now, what's this? The monetary policy can be expansionary or restrictionary or contractionary. Restrictionary is same as contractionary. When you say the monetary policy is contractionary, we mean it is restrictive. It aims at reducing money supply. All right? Expansionary monetary policy is about expanding money supply. Eh? It is calculated at increasing economic activities and increasing the supply of money. And that one, we've said, if you want to increase the supply of money, you buy bonds, buy treasury bills, reduce the reserve requirement ratio, and you reduce the what? The discount rate, isn't it? When all those things are done, you will see the effect. Money supply will increase, the interest rates will reduce, aggregate demand will increase, and the investments will increase, consumption will increase, exports will increase, income will increase, everything will just increase, including exports will increase. All right? Those are the ripple effects. When you increase money supply, interest rates reduce, aggregate demand increases, investments increases, consumption increases, exports increases, general income increases at that point. All right. There is also what you call the restrictionary fiscal policy. You can read out these things at your own time. The restrictionary or restrictive monetary policy or the contractionary, this one is the opposite. You sell bonds now instead of buying. The reserve requirement ratio increase, the discount rate you increase. And what will happen to money supply? Money supply will reduce, the interest rates will increase, aggregate demand will reduce, investments will reduce, consumption will reduce, exports will reduce, total income will reduce, output will reduce. You get what I mean? And also employment will reduce. So the contractionary or restrictive monetary policy reduces money supply. And as monetarists, we believe that when money supply is reduced, the interest rates will increase, then aggregate demand will reduce, investments will reduce, and that's true, yeah, because investments are from loans that people get now. If people are not getting loans, there's no money supply, too little money in supply. You have reduction also in consumption, exports are reducing, income is reducing, output is reducing, and employment is reducing, which means at that point you have more people unemployed. So basically, this is how just the supply of money, have you seen that just controlling the supply of money, it affects so many variables. Have you seen? It affects employment, it affects output, it affects income, it affects exports, it affects consumption, it affects investments, it affects aggregate demand, it also affects interest rates. That's why the science of money supply is it's a giant science, and people need to have proper understanding of the same. All right. And so basically, this is what really happens. And so the money supply has to be increased. And if you understand the science, then you will be fine. Before I close this conversation, let me explain now what determines the demand of hoarding money. Keynesian John Maynard Keynes in 1936, he postulated, and the proposition was made that people hoard money for various reasons. People want to hoard money for various reasons. And number one, they demand money. In other words, you demand money for the following reasons. Number one, for transaction motives. That's why you hoard money. And please, for the sake of an exam, you should remember the motives of people hoarding money. Hey, they're just these. Transaction motives, or the transactions demand. This has it that people demand to hoard money. They keep money in their hands. They want to hold money to meet transactions. For example, they want to buy this today, you have money. You keep some money just, to prepare to buy. You're going to buy tomatoes, you're going to buy whatever, bananas, you're going to buy, I don't know, whatever you're going to buy, like you're keeping the money to go and buy some. That is what the transaction motive is all about. Then the precautionary motive, the precautionary demand, this one, people hoard money to take precaution. That is to prepare for unforeseen circumstances. We hoard money because we don't know what the future has, all right? In case of emergencies, we should have money. So people just hoard some money. They will not really just, do without money. They will keep some money so that, with a motive that, okay, should anything happen, at least I should have some money which is more liquid. Not keeping all your money into hard assets that are very hard to convert into cash. It can be hard. That's what is precautionary motive is all about. Finally, I present to you speculative motive or speculative demand. This one, it means people are holding money for speculation. By speculative motive, we simply mean they're expecting some economic environment to change. So they are holding this money thinking that maybe things will change. Take, for example, maybe the prices of some goods are expensive now. So they will hold the money to say, let's not buy now. Let's keep the money so that when the prices go down, we buy. Get what I mean? We'll buy when prices go down. Then they'll hold the money for such. Or they will know that, oh, these things are going to be available for sale, maybe at a good price, maybe after 6 months. Let's hold the money and wait. That's what the speculative motive is all about. Money held for the purpose of making everyday market purchases, that is transaction motive. Precautionary motive, money is held for unexpected market transactions or for emergencies. And the speculative demand, we say money is held for speculative purposes for later financial opportunities. Why do you hold the money? There are 4 key factors that influence the 3 Keynesian motives of holding money. Number 1, the price, the income, and the interest rates. On the price, this is about inflation. And here, this one says that if the price rises, then people need to hold the higher money balances to carry out day-to-day transaction. In short, when there is inflation in the country, like things have started becoming expensive, you need to keep more money. So you see many people demanding a lot of money, sacks of money with them because they know that things are expensive. You go tomorrow, you find that things have already added by 20%. And that is what we mean by pricing affecting the motive of you holding money. All right. Income. This one has it that as people make more money, the more money you make, the more income, the more you spend. And that's, you know that from practice. People who make money, like, you meet money, you hold the money. You hold the money maybe every day. If not every day, maybe every week at least there are some transactions that go on. Those people, they spend the money. They are not afraid of spending. But someone who holds the money maybe once in 3 months' time, for example, when they hold whatever money they hold, they are careful. They are like, this money we can't just spend anyhow. We have to, money is difficult. But this guy who makes money every day, easily spend. This is according to the Keynes interest rates. The quantity of money demanded goes down as the interest rate rises. There is an inverse relationship. So if the interest rates go up, then people will reduce how much money they are trying to hold. And the opposite is true. And the credibility available, the credit available, if you can get credit, you don't need to hold much money. That is credit availability. This one influences also how much you can hold money, right? If the credits are available, you know that, let me not just hold much more money, because I know that whenever I need money, I will get the credit somewhere. But if you know that credits are not easy to find and there are collaterals that you may not manage to meet and all sort of things, at that point, it becomes very tricky. It becomes very, very tricky and very crucial. So at that point, colleagues, what do you need to do? You need just to hold more money. But if credits are available, you don't need to hold more money. Okay. Obviously, you've gotten this message that you're trying to send across. So basically, this is the message that we are communicating again and again and throughout. Okay.